Good morning, everyone, and welcome to our special webinar focused on SFDR review. Welcome, everyone. I'm Linda Zeilina Cross. I'm the founder and CEO of International Sustainable Finance Center, an independent think tank based in Prague. ISFC was a member of the previous sustainable finance platform that worked on the delegated acts and also on the simplification and all the reports that appeared under the previous platform's mandate. So today we are hosting this webinar in collaboration with fantastic organizations that are working on sustainable investing across the Central and Eastern European region. We have sustainable investment and finance forums from Czech Republic, from Poland, and from Hungary. So if you have not heard of them, please check them out. And you can find useful content and latest analysis on all of the developments on sustainable finance and sustainable investing. So today we have the great pleasure to have perspectives from market. We have somebody who will speak to us from academia and research side, and we also have a DG FISMA European Commission with us today to also answer questions. So please note you will be able to use the Q&A section to submit your questions and actually receive direct answers to those. So without much further delay, I would like to introduce Hannes Huhtaniemi, who is joining us today from DG FISMA, who worked on the SFDR review, and who will explain how did we end up with the review that we have and what are the key elements and changes that you will see in the document. So Hannes, welcome, and the floor is yours.
Well, good morning, Linda. Thank you very much. Good morning, everybody. I'm happy to be here today, this morning, to give a bit of an overview of the proposal that was adopted last week on reviewing the SFDR. Apologies for the last-minute change from our side. My colleague Matilda, who was initially supposed to be here this morning, couldn't attend in the end, so I'm filling in for her. Just a few words of background and context. I think more or less everybody here will probably be familiar with the SFDR as a framework, but this review that culminated in the proposal that was adopted last week has been underway effectively since 2023 now, when we first launched two sets of public consultations to inform possible changes that you have now seen last week. Since then, we've also been able to benefit from extensive expert input in the shape of reports from, for example, from the platform on sustainable finance, 2 reports, in fact, from the European supervisory authorities, and continuous engagement with other experts, stakeholders, NGOs, academia, etc. Just to complete the picture in terms of how we got here, you will also know that in 2024, ESMA proposed its what it calls its fund name guidelines for investment funds utilizing ESG terms in their names, which created new or introduced new minimum requirements for those cases. So that's an important element which you will have seen is also informing the review. Then in February this year, we had the Commission's proposal for simplifications to corporate reporting, this so-called Omnibus 1 package, from which mostly involved changes to the CSRD, the CSDDD, so these corporate sustainability directives, and to some extent also the taxonomy, which has since been further fleshed out and rolled out. So this is yet another element of context which I will, which has fed into the review and which I will explain and which we can discuss. And then the final point, to really set the stage for all the elements that have got us here, is the publication by the Commission at the beginning of October of certain level 2 measures which were considered less of a priority at this stage. So this is something we've also reflected in our proposal. So what were the key aims throughout in what we have done? Obviously, in the present context, simplification has been a key aim. The feedback suggests that there are several features of the existing regime which can indeed be simplified and streamlined. The important goal has also been to improve the functioning of the regime for investors, improve the way that investors are informed about the sustainability features of different financial products, and ultimately these changes towards better transparency, simplified rules is intended to help improve the efficiency of the regime in fulfilling its ultimate objective, which is to help boost the flow of funds towards the EU's sustainability ambitions and priorities. Importantly, of course, we wanted as well, in pursuing these objectives, to maintain a balance between continuity with current rules on the one hand and the changes that have been brought out, for example, with the ESMA fund name guidelines for financial products, which are in the scope of those guidelines. So continuity on the one hand, and then environmental and social, ESG, if you will, ambition on the other, to make sure that we deliver on the promise that the SFDR set out to achieve, which is to ensure that there is the concerns of possible greenwashing in this space are effectively mitigated. So that balance between continuity and ambition has been a key element in what we've been trying to strike. So how do we do this? How do we achieve this balance? Well, you will have seen that the main innovation here is the introduction of these three product categories, which we will discuss in detail, and also to replace what are today relatively lengthy and complicated disclosures with something that is much more simple, much more limited to key data points, which our work shows are the most meaningful for investors, most available based on data which flows from corporates, for example, under the CSRD, which can be estimated with a reasonably high degree of confidence or reliability, and therefore which is most meaningful. Now, this doesn't mean that some data is inevitably not lost. That some data points are lost in the process, but we believe that in this process of trying to achieve a balance, the data that we have set upon relying on is the one that strikes the balance that we've been trying to achieve. So the three categories, which are 1, sustainable, 2, transition, 3, ESG basics, and called that way in the text after some back and forth on whether or not the naming of these categories should be left to level 2, but we can discuss why that was instead finally decided to do in level 1. The three categories are based on all of this extensive feedback that has fed into the review and are seen as overall a better way of delivering on these objectives that I just laid out, and better than other alternatives, which were also floated in the process, in the preparatory process. For example, an idea which was put forth by the European supervisory authorities to have 2 categories, only sustainable and transition, but which we believed came with certain issues, notably to do with the possibility that you would then have very ambitious categories for sustainable and transition products, capturing a small niche part of the market, and then potentially a large segment of non-categorized products making other ESG claims, which could be a bit of a confusing situation for especially retail investors. And also, we think that the third category is essential in being able to accommodate, for example, some products that may struggle to reach the thresholds and the criteria of the first 2 categories, namely insurance and pensions products. So that was another important factor. There are others as well, which we can go into as well. The categories, as you will have seen, rely on some key pillars. So first is this requirement to ensure 70% of the investments per category, per categorized product, contribute or integrate the key sustainability factors that the product pursues. So to align with largely what was in the ESMA fund name guidelines, which had a level of 80%, and also the requirement there to have a 50% in case of sustainability products using sustainability in their names, to have 50% of these sustainable investments under the current regime. So we thought that between these two parameters, 70% achieves the right balance. This is also consistent, as you know, with what the UK has in their SDR regime and some other international equivalents. The 70% can be achieved through a number of listed measures or investment approaches in paragraphs 2 of each of those articles on creating the categories, but without excluding others. So there are things mentioned like the use of the EU taxonomy, of course, which remains an important tool, use and reliance on the EU Paris-aligned and climate transition benchmarks, which also inform the exclusions, which I will mention next. And there are safe harbors for the use of certain safe harbors are provided for also for the use of the taxonomy and the PAB-CTB benchmarks in order to boost usage of these established EU concepts. And then, yes, the final part of the categorization is this reliance on exclusions, so replacing today's DNSH requirement in the sustainable investment definition with clear-cut, mostly binary, more easily usable exclusions. And these exclusions are taken from, as I mentioned, from the Paris-aligned and CTB, the climate transition benchmarks, which have been in application for some time and which were also underlying the criteria of the ESMA fund name guidelines. You will see that we don't rely on exactly the same baseline as the guideline, the ESMA fund name guidelines for how those exclusions apply across the categories. There are certain variations, notably an additional requirement to ensure that products in the sustainable and transition categories do not fund investments in companies that are expanding fossil fuel activities, which was in the overall architecture considered an important addition for credibility, for ambition, and to mitigate concerns of greenwashing. So that's the main core of the text, the main innovations. Of course, the changes you will also see there involve a removal of the current entity level disclosures that were there, to do with the principal adverse impacts, something which generally the feedback suggested was not considered to be fully effective, not considered necessarily to be all that useful, and therefore the consensus largely seemed to support removing those requirements entirely. Those are the main changes. There's a few novelties as well. For example, we've added an article for products which use the categories to allow for example, pension funds, insurance funds, again, who may not be able to achieve the thresholds of the sustainable or transition, or indeed even the ESG basics category, perhaps, but to still be able to use the categories to inform their investors on the extent to which they invest in products which themselves are categorized. And basically then two options emerge from that. So either you invest to a degree to which you are already then achieving the 70% threshold in terms of coverage of investments that support ESG objectives, and then provided that you also comply with the exclusions, that product which invests in other products can itself be also considered categorized. And then there's a certain cascade logic which applies as to which category it would then fall into, namely that only products which invest fully in line with the sustainable investment parameters would remain would call themselves sustainable. If any of the investments involve transition-related investments, then it cascades, it defaults into, if you will, into the transition category, and then similarly, if the investment profile involves elements from the ESG basics category, then it would be categorized accordingly and under the ESG basics group. And the second trajectory, which is signaled there, is that if you do not reach the 70% threshold, you can still inform your investors, your policyholders, your pension holders, whoever they may be, of the degree to which you invest in the categories by showing the relative shares of categorized versus non-categorized investments in your overall product or pension scheme or the like. The other novelty is the article we've introduced on data and estimations. This was a much noted, not to say criticized, feature of the existing regime, that there was a large-scale reliance on estimations in the past, but there was no sufficient guidance or formalization of the practice, really. So what we've attempted to do is to clearly formalize the use of estimations for any data needs under the future framework, with some basic transparency rules around what that would then, or how information on the degree to which and how financial market participants rely on estimations, basic transparency that would have to be provided to investors on request. A point which we can discuss, which many have commented on, is should we not have also introduced requirements for ESG data vendors, external third parties? But this was considered complicated in the current environment, where we're trying to simplify the framework and not necessarily add new entities into the scope. And this we can also touch upon a little bit more in detail. I will just finish with, I think I'm coming to the end of my allotted 15 minutes, so if that's okay, Linda, I'll just finish with a number of small remarks. Yeah, thanks. You will see that instead of today's quite expansive empowerments for developing rules in level 2 measures, we are trying to be quite circumspect and quite restrained in this regard for the future. This also reflects all of the simplification priorities which I've outlined, which you all know, and the spirit of this deprioritization list, which the Commission published there at the beginning of October. So instead of today's more expansive level 2, we propose to focus essentially on designing brief, short disclosure templates for different categorized products through such level 2 measures, which would be done by Commission delegated acts instead of regulatory technical standards by the ESAs, for those of you interested in the differences between the EU architectural features. And also this level 2 could touch upon adding some details to the different approaches, the investment approaches that qualify under each category. This is not spelled out that we will necessarily do that, do those specifications, but for example, it has been suggested that the Commission could, in a second step, design certain indicators which could be used on a voluntary basis by financial market participants for given products. Say climate products could be an indicator could be designed for them for their use in that regard. And then the final thing, which we also do get many questions on, is, well, what will happen to the distribution rules under for inquiring about investors' sustainability preferences under the MiFID and IDD rules? That will also be developed in a second step in this level 2 package, in order for those rules to reflect the future SFDR in the appropriate way. So that will be done all together in a level 2 package, and everything will then hopefully be able to enter into application at the same time. We've foreseen 18 months after entry into force for all of this work. let's see, it's now in the hands of the Parliament and the Council, how quickly they wish to proceed. Our first feedback that we get, mostly from the industry, I can't speak to the position of the Parliament or the Council yet, but the industry feedback that we've so far received seems overall generally positive, not unanimous, of course, but this is something that seems encouraging for the work that awaits us. And with that, I think I will conclude, and happy to discuss any of these points or anything else which I may not have touched upon. There's various others, of course. So with that, I hand back the floor and happy to take any questions or start the discussion.
Perfect. Thank you so much, Hannes, for the comprehensive overview of the main changes. And indeed, the first reaction has been overwhelmingly positive, also from what we have seen from our stakeholders. So speaking of market participants, I think I would like to turn to Julia, and then we will start tackling also the questions in the Q&A option. Just to remind everyone, the Q&A is open. You can submit your question. We will answer them live. So turning to Julia Backmann, representing Allianz. Julia was also a member of the previous sustainable finance platform at the EU level that finished its work March this year. And Julia worked on the paper that the platform published on SFDR, suggested categorization. So I think as a rapporteur for that stream, we couldn't have anyone better than Julia joining us today. So turning to you, Julia, so as a market participant, for you, does the new SFDR categorization provide more clarity? And what are the main advantages of these particular changes and thresholds? So is this a simplification, and what is your view on it? So over to you, Julia, please.
Thanks a lot, Linda, and thanks, Hannes, also for introducing the changes. And let me congratulate you, because what we see is really a proposal that is striking a good balance between looking at continuing what the market has working on over the last 4 years and what the market has developed over the last 4 years, while at the same time simplifying everything. So I think that has been really a very, very good proposal that is there. Also, being courageous in allowing the 3 types of categories is very important for the market, also for investors to get on board with all the systems and approaches that are out there. I also want to highlight, because I know it's politically not easy to drop things that are somewhere in the regulation, that you decided to drop, in particular, the PI statement on entity level, because that has been a huge, huge effort, where at the same time we haven't been able from the market side to see a real sense in that. So it's very good that the Commission is moving in that direction. Now, of course, there are a couple of questions that arise on our side as well, and where the industry is looking at to, get maybe a little bit of change in that, or get started in the discussion how the market could move in that direction. And the main concern probably is with respect to sovereigns. And we have had a huge discussion also in the platform. How can we treat sovereign investments within the categories? This is important for the fund market. It's of even greater importance for the insurance market, because of the general account and because of the investments that are already there. So that is something where we would like to evolve in the discussion, and I understand the Commission in this respect, that for the time being they identify there are no tangible methodologies to deal with sovereigns. We appreciate that. That's clear, but I think it would be great to have some kind of openness in the proposal if these methods are developed, that this can be recognized. You've also touched base on the treatment of multi-option products, and I think the market is learning what is meant by the proposal. It's not an easy one to digest, but we appreciate the fact that this is taken into account, that we can find some practical way of dealing with this. Of course, in the end, it will very much depend on the acceptance on the retail investor side and the understandability on the retail investor side. But I think the discussion on that one will evolve a little bit more. Maybe one other bit the market was hoping for, and we saw it in the leaked draft, it has been dropped in the end draft, that was the inclusion of professional, or the exclusion of professional investors, the possibility for professional investors to not follow the rules of the categorization and the limitations. Why is that important? Because professional investors usually have a very clear view on what they want and a very clear view on what they need. And if you have tailored rules, that's not necessarily aligned with their ideas. So unlike as in the retail market, where product providers start identifying what are the rules and how should the product look like, what are the elements that are relevant there. On the professional side, usually the investor comes to the product provider and says, look, I would like to have a product that caters for A, B, C, D. And for that, the SFDR, the current SFDR has been kind of difficult to handle because it looks at it rather the other way around. Why would we have to disclose to an investor the things he basically dictates us? And that is something where we would like to go into a further discussion. There are also a couple of technical elements, and I just want to highlight two. So first of all, I think there has been added the exclusion of companies that derive more than 1% of their revenues from coal. Again, between the draft and the final text. And that for us in particular on the transition category is kind of not consistent with the methodology, because the transition category is of course looking at how can we get companies on the pathway of sustainable finance, of sustainability. So if at the moment, a company is having that share of revenue, I think the more important bit, and that has also always been the platform's view, is that we limit build out, but that we are able to actually also invest in those companies and allow them to go on the journey. And maybe one last bit we recognize that in the basic categories, the idea of best in class is something which is used broadly in the industry, raises some questions in terms of how it's catered for. What do I mean with that? Now, the way the text is currently drafted seems to look like at a specific investment and not at the investments on portfolio level. So maybe that's something where we can take a closer look and have a broader discussion. And I stop here. Thank you.
Thank you very much, Julia, for your take on the SFDR, and also for congratulating DG FISMA, because this, I'm sure, was not an easy effort. I'm really happy that we also are getting a lot more questions flowing in, so please keep them coming. So I'll give quickly the floor to Gabija, who is joining us from University College Dublin. She's a researcher on sustainable finance and is working on portfolio alignment, net zero strategies, and so on and so forth. Unfortunately, Professor Andreas Hoppner couldn't make it, so Gabija is an expert from his team in Dublin. So just quickly going to Gabija, my question to you is essentially, what will the SFDR categorization and data requirements, will they address greenwashing concerns? Because we have seen that some institutions have raised concerns that they would have liked slightly different data requirements, etc. So since you're also working on a big project, tackling greenwashing. It will be lovely to hear from you, and then we will start tackling the questions in the Q&A. I think there's some very pertinent, interesting things asking about what regime funds should start using in 2026 already for building new funds, and also the role of taxonomy. But over to you, Gabija.
Yeah, thank you very much. Absolutely, the topic is at the heart of all of the research effectively that we do with Andreas Hoppner. So data intersection together with the greenwashing concerns is at the very core of the work that we do in terms of net zero strategies and how investors should approach this. So I think in summary, the greenwashing concerns could come from the fact that SFDR previously in version 1.0, as I like to refer to it, was intended to be a disclosure based framework. It wasn't supposed to be a categorization. However, market automatically almost indicated where they're tilting and what would serve the market better by treating the Article 8, Article 9 almost as categories eventually once that got widely adopted across the market. So I think the key aspects then that are addressed in the SFDR 2.0 are really the shift to the categorization. And I think the introduction of clearer definitions on Article 7, Article 8, Article 9, so also being referred to as the actual keywords of sustainability transition and ESG basics is really welcome from the market. I think something that we've heard in our work and interacting with industry quite widely and quite frequently was the fact that the subjectivity of sustainable investments definition, the subjectivity maybe to how you define your DNSH criteria and other aspects that were embedded in the Article 8, Article 9 categorization before really made it difficult to compare the strategies, and it almost created no level playing field across different participants in the market where, depending on your definition, you may fall in or out of favor with certain investors and certain clients, especially on the asset management aspect side of things. So I think the dropping the sustainable investments definition is definitely a welcome change there from the market, but also introducing the alignment thresholds and exclusion criteria sort of creates that nice clarification of what are we actually creating here. And I think Julia really rightfully so raises a question, let's say even, that pops up now, should coal exclusions be in Article 7, i.e. the transition category? And I think that's worthwhile to discuss because effectively the issue that you're addressing there is a fundamental question of, do you think the fossil fuel expansion should be in the transition category, right? So fossil fuels to me sort of come hand in hand, right, with the coal question. And I think those are important questions to raise. So that allows us now to have those types of conversations where once you introduce those sort of clearer guidelines, you can then further on discuss on what is actually worthwhile and reasonable and important to have in those categories. And I think it shouldn't be overlooked how nicely that actually aligns with the EU's toolkit. So how clearly it now aligns with the climate benchmarks and Paris line benchmarks, and how that then indirectly or semi-directly relates to the investing for transition benchmark. So I think it's easier now for investors to actually use the tools and to have a clear guideline that is now written in the regulatory proposal rather than as was maybe Q&A from before of how you can actually use these tools and the fact that PABs and CTBs are given a safe harbor. And I think a very important point that shouldn't be overlooked is what Hannes talked about, the data quality. So data quality cannot be underscored here because while a lot of the responsibility falls, let's say, on the professional investors themselves of how those strategies are designed, or maybe the market participants or the asset managers that design the strategies, understanding the data underneath is really at the core of this work. So whilst you can look at the methodologies that are quite well developed at this stage, even when you would take the emission estimation methodologies, they still differ vastly across different providers. And I think the disclosure of estimation methodologies really will enable the quality of the data to improve, but also the auditability of the data that we put out in the market.
Brilliant. Thank you very much, Gabija. I think we have a lot of questions coming in, and I know that, Hannes, you might need to leave us a few minutes before the end of the webinar. So I would like to actually turn to you with a couple of questions. So number one, I do think that the question around which regime should funds raising new funds and creating new products, what should they use in 2026? Because I think this is a key thing that market participants are asking. And the second question, of course, the role of the EU taxonomy in this new SFDR review. So one of the questions is, what is the rationale for allowing sustainable investment products with 15% of EU taxonomy alignment to meet the 70% requirement of the category? It's quite a technical question. I think one of the taxonomy questions also comes from a Sherpa from the previous platform, so with a bit more knowledge of the EU taxonomy. So over to you, Hannes. Also, if you want to pick up any other questions that you've seen in the Q&A, please feel free to address them as well. So over to you, Hannes.
Yes, thank you, and thank you, Julia and Gabija, for the nice feedback. I think the comments that you raise are eminently treatable when we come to the discussions between Council and Parliament. Sorry. On the question of new funds, well, the old rules, the current rules apply until the new ones do. So the way we foresee this is that, or the way we think this could work is that the new rules would take around a year to negotiate. That's just a rule of thumb, but by no means necessarily scientific. It can be something shorter, it can be something longer. And then after it enters into application, which say could be sometime in 2027, there's the 18 months implementation period before the new rules begin to apply. So that won't be until sometime in 2028, most likely. So until then, the existing rules apply. So for new funds launching between then and now, that continues to be the case. Of course, you know, we're not here to say exactly what rules funds should how funds should set themselves up. So they're free to take inspiration from the rules, of course, as they appear to be evolving. The 15% on the taxonomy. So this was felt an important addition together with the safe harbor for the PAB and the CTB portfolios in order to confirm the important role of these EU instruments, these EU standards, and notably here the taxonomy as sort of the gold standard when it comes to sustainable investing. The 15% is, we think, a number which the platform helpfully supports in its analysis as representing something which is sufficiently ambitious in terms of the current product offering out there, but yet achievable by a good number of products. So if we take the analysis of the platform, it seems that roughly around half of current Article 9 products could potentially be able to operate with that figure. So this is our suggestion. We'll see how it lands with the co-legislators. The broader idea being that if you are investing in the taxonomy, 15% is a sufficiently large number to ensure that the overall product, the footprint, if you will, of the product is positive, and then it's less important what's in the rest of the 85%. Although, of course, that will have to be subject to the general rule of it not being misleading, or it has to be fair and consistent with the overall claims and objectives of the product. And importantly, of course, the exclusions would still, of course, have to be checked, and they would continue to apply. Maybe I can just react to a few questions which I'm seeing in the chat. I do see quite a lot of questions on how the future level 2 will be articulated. And just to confirm what I tried to hint at originally is that we hope to have left enough time to make sure that the future level 2, unlike was the case with the current SFDR, that in the future level 2 will be able to apply from the same date as the future level 1, and notably for the new rules under the MiFID IDD that govern distribution and asking about investor sustainability preferences, that those will be developed, prepared during the implementation phase in a transparent way, as delegated acts are, and integrating stakeholder feedback, and then allowing for everything to enter into force at the same time. As I said, let's say sometime in 2028, but that's beyond our control in terms of being able to identify a specific date already at this point.
Hannes, is it okay if I jump in on specifically that point, because that is of a great concern, of course, for the market in terms of how does the implementation work. Now we have a very complex situation because we have, of course, level 1 and then level 2, both on the SFDR and the MiFID side. You've laid out that some of the level 2 on SFDR might even come at a later stage and might be voluntary, which is if they are voluntary, very helpful. But I think getting that right will be very crucial in terms of how does that timeline work. Because, of course, you as the legislator need to have sufficient time to think about it, to get it right, to think through. We also have level 3 on the MiFID side, which is the guidelines. They should ideally, and IDD as well, ideally be there as well, because wherever we have a staggered approach on legislation, that means we have to undergo a couple of implementation efforts in a row. And that means actually programming systems, getting IT right and everything. So we have had experiences in the past where it was really difficult for the market. And given this one is a very complex situation, we as industry, I know we would like to work with you to get the timeline as best and as easy for everyone to set up, because what we would like to avoid is several implementation stages, as we have seen it with SFDR level 1, for example. So just this to highlight this, I wanted to put that forward.
I don't know, Hannes, would you like to respond to that before we move on, or? No, okay. Well, Julia, I would like to also ask from the market participant view, what do you see as the main challenges in the move to the revised SFDR from your point of view? I can see in the questions that there's multiple questions related to this, and also, of course, concerns about the omnibus simplification package, where the scope has changed, a lot of things are voluntary, so we haven't actually resolved the underlying issue of the data that we need, the disclosures that we need to structure this. So maybe if you have any thoughts on that.
Yes, so maybe let me start with one remark. Whenever we have new regulation coming in, we would need to perceive that as a process, because the regulation comes out, then there is discussion, then we need to, get a grip, get an understanding, do our analysis ourselves. What does that mean for us? And that keeps, of course, changing, because also forming a view, a common view between the stakeholders, so the legislator, the supervisory authorities, the auditors, the product providers, the distributors. So that takes a little bit of effort and time. And I think that is for us to always be aware of that this is something that we won't have clarity on day one, but this is a process. So we need to work on that process together. Now, the two main challenges I see, the first one I just already addressed, that's the timeline, getting the timeline right. And as I said, this is of utmost importance. The second one is definitely to understand what data do we have available, specifically with respect to the categories. And as Hannes alluded to, as the platform, we have done a lot of analysis around some data being available, some data being not yet available. So, for example, the build out of fossil fuel, we don't see a lot of data yet available there. So there's something to work on and to see how we can get to that and where we can get that information. Again, this is something where we as an industry need to take a little bit of time to digest, to identify. And I also saw a question, I think it was Isabel Royce who asked the question about what about the transition plans? I think what we see in terms of the data that is mandatorily to be provided by companies, we see kind of a backlash there, given also the change in the omnibus. But at the same time, I think as a market, we need to understand that while there might not be regulation there, as long as we have standardized understanding of what we need from companies, we can still do that on a bilateral or industry-wide basis and ask the companies for the information we need. So I think in this respect, the more clarity we have on alignment, the better it is. And there is a lot of work that is done. And I want to conclude there with a bit, I think I mentioned the PI statement. We also recognize the efforts of the Commission to align CSRD and SFDR metrics in this respect. And I think that is also something which we are fully supportive, because if we are talking about the same thing, we might have different approaches to measure and estimate and value it. But if we have a clear common language between companies and financial participants, that would be the goal we are looking for, and that would help the cause anyway, whether it's mandatory or voluntary.
Thank you, Julia. That's a very good point about the common language. We definitely need it. The standardization of absolutely everything is not very easy, and it is a process. So I think we're definitely moving at least in the right direction. Gabi, if I can turn to you now with a quick question before I go also back to Hannes with a couple of more questions from the Q&A. So the previous Sustainable Finance Platform did publish a report on monitoring capital flows. We have seen that the new platform that will start operating in 2026, as one of its tasks, also has the publishing of the next capital flows report, an updated one, and working on transition finance, etc. So my question to you is the current approach to SFDR and the data that it will collect. Will it also help to monitor, to understand and monitor the capital flows related to investments? And any other thoughts that you might have in the reaction to what we have heard thus far?
I really like how this discussion is playing out, because I can almost build on your comments and on Julia's comments. So I'd say the two key, well, actually on Hannes's whole conversation as well, I think really the key on monitoring the capital flows, and maybe more importantly, directing them, is I'll come back to the introduction of categories, and probably, Linda, your comment then on standardization. Standardizing absolutely isn't easy, but introducing clearer categories that are that embed the other regulatory frameworks within the EU strategy is essential. And I think that's exactly what SFDR is currently doing, and doing it pretty well. So I would almost describe it as, what is the regulation trying to tell you? Well, it's almost shifted from these descriptive categories or descriptive disclosures to outcome-based categories. So on the ESG basics, you basically have limited or no particularly targeted sustainability outcomes. You have to have some, but they're not as stringent. For example, Article 7 very clearly tells you sustainability outcomes in transition, right? And Article 9 then likewise, the sustainability category tells you that you have to have a very clear outcome, right? So it's almost that the articles now are dictating the ambitiousness and maybe the rigor with which you're directing the capital towards those investments. Then additionally, again, I'll come back to the point that PABs and CTBs are integrated really nicely. So simply by tracking even the capital that sits within these investment products, and then hopefully in the future also integrating investment for transition benchmarks, that allows you to monitor how the market is developing, how the flows are moving within those products. And then of course the categories themselves, if you can track the flows within the categories, really simplifies the whole process, because all of a sudden now you have somewhat of a more structured, more standardized way of what we're actually measuring, where are we directing the capital flows. Now, I saw a comment in the chat on whether you can maybe align in the Article 9, the taxonomy alignment and the sort of the threshold percentages there. I think I'm not sure if that's a good idea, maybe just to address that particular question, because quite likely the investments that you have in your portfolio that will sit within the sustainable sort of portion of the portfolio are likely to also fall within the alignment of the taxonomy, or maybe more likely than not. So I think that's the sort of separation of the two is there for a reason. But something that maybe I would touch upon is the Article 7 and sort of how Article 7 tells us that, yes, you want to align towards transition by having no fossil fuel expansion activities. So I think that's circling back to Julia's point on taxonomy alignment data, right? So I think investment for transition benchmarks really nicely integrate the CapEx metric of taxonomy aligned CapEx, right? And I think for Article 7, that's going to be one of the fundamental metrics to really address, whilst maybe the other data points are still developing on how we actually measure the fossil fuel expansion, right? Whether it would be through revenues or other data points that we have in the, and I think that the taxonomy aligned CapEx will really come into play as one of the fundamental metrics in actually ensuring the redirection of capital flows efficiently.
Thank you very much. I think it's an interesting point to raise, the fact that the CapEx, taxonomy-aligned CapEx use has definitely expanded across the market and is also very important from the supervisory perspective, trying to understand whether certain parts of the economy are transitioning or not and how the capital allocation is playing out, which is extremely important also for the next capital flows monitoring report. If I can return quickly to you, Hannes, since we have quite a lot of questions, we definitely won't be able to tackle all of them, but hopefully this gives an interesting insight in terms of what people are thinking and what they are concerned about from the market perspective. So I wanted to ask maybe a little bit more about the regulation, if there's any updates on the regulation introducing the obligation to ask clients about their ESG preferences. So this is the ESG preference question. There is a concern that maybe the current questions might not be compatible with the suggested new categories. So is there any kind of update or thinking around that or planning for changes there? And also any other questions that you see that you would like to tackle, or any final thoughts, since I'm aware that you might have to leave us soon. So over to you, Hannes.
Thanks, Linda. On the point on ESG preferences, I think this is an often raised concern, well understood, that the existing requirements, which refer to SFDR existing concepts and taxonomy concepts, are not well taken up, or there's a challenge in understandability on the part of investors and being able to put that into practice on behalf of financial market participants. So point well taken. However, the existing regime will continue to apply until the new one does. So the existing regime, with its references to PIEs, sustainable investment, mandatory taxonomy alignment factors, will continue to be a case, will continue to apply until the new regime does. And I can only repeat what I said earlier, and also in reply to Julia, your point that you made just now. The idea is to develop the new level 2 which will match the new SFDR in an open, transparent way once we have more or less the contours of the future SFDR agreed by co-legislators. So at that point, we will try to start the process of making sure that it becomes clear what the new set of questions, if you will, under the MiFID IDD level 2 will be under the SFDR when everything starts to apply at the same time.
Thank you very much. I think that answers quite a few of the questions that we saw in the Q&A concerning the timelines and the next steps and next developments. So if I can turn back to you, Julia, in light of, there seems to be a lot of questions around the transition versus sustainable categories, etc. We also can see that there is a bit of concern about how that might affect venture capital and smaller entities that are working with SMEs and other entities that are not within the CSRD scope or are maybe too small. So I don't know if you have any thoughts or reactions, both to Hannes and also to some of the questions in the Q&A section.
Yeah, I mean, specifically on the point between the categories, I think that is something where we had also on the platform a lot of discussions. How do we distinguish between the categories? And if I look at the funds, because they are dearest and nearest to my heart, there are, of course, changes throughout an investment period of a fund, always, right? And sometimes a fund might be nearer to one category and sometimes to the other. But what does not make sense from a market and from an investor perspective, if we have a need to switch categories as soon as we arrive to a certain threshold in the other one, that doesn't help the cause and that doesn't help the investor. So in this respect, as the platform and as the market, we've always advocated for the fact that, you know, we can decide as product providers which criteria we want to fulfill. We are going to be adhere to that and stick to that, even if at one point in time we would be able to change a product, for example, from a transition category into a sustainable category. That might not be the long-term strategy of that fund. So it needs to have that flexibility, which at the same time comes, of course, with the point that we might not always have a clear distinction cut between the categories. But it comes back to what the product provider decides as their core strategy. And I think it's important that we retain that flexibility and live with the fact that there might be funds that could well be for a certain period of time, even in two or all three of the categories. So that's my take on that one.
Brilliant. Thank you very much. Right, so we only have 2 or 3 minutes left, so I don't know if anybody would like to, Hannes, if you would like to have some concluding remarks just to wrap it up, and the same goes to you, Gabija. I think we have plenty of questions to think about. There's one question that I don't know whether this analysis will be published, but Hannes, there's a question of whether any impact analysis has been done or whether there will be any publications looking at a view on the possible reallocation of funds. I would imagine that this definitely will be something that people will explore, and I would imagine from researchers' point of view, Gabija, that would be also interesting to see. So anyway, over to you, Hannes, for a 30-second quick wrap up. The same for you, Gabija, and then finally, Julia.
Thanks again, and thanks for all the questions and for the good discussion. On this question of whether there'll be further analysis published on the potential impacts and breakdowns of how funds will be categorized in the future, beyond the impact assessment, which has been published, we don't foresee that at this stage. We didn't think it was very instructive or informative for us to speculate too much at this point on how exactly future funds will divide between the categories. It could have been an interesting academic exercise, but that would have been all it would have been at this point. It will be interesting to see how this actually plays out in the future, and this is something that we're also interested in hearing the feedback on from stakeholders when they come see us, how they see that potentially maybe the long tail of Article 8 products could effectively be completely removed from the categorization, but the more robust end of the Article 8 spectrum could, and where would that fall? Would it fall within the ESG basics, or could it even maybe move up into the other categories? We can extrapolate a little bit, I suppose, based on the effects of the ESMA funding guidelines have had, but we didn't start to do this analysis yet. But this is something I think we can continue to engage on with the industry and learn from, and help inform the co-legislation process as it plays out. I do note that there are a few questions in the chat about questions of scope. We've changed, we've taken out portfolio management, we've taken out financial advisors. What happens to, for example, structured products, which are under PRIPS, but not under the SFDR? These are all very important questions which have been raised, have been discussed in our preparatory process, and I'm sure we can continue to come back to that. But for now, for me, thanks a lot for the discussion, and I hand back the floor to you. Thank you.
Thank you very much, Hannes. Very useful. And any concluding quick remarks from Gabija and Julia?
I'll make it short and quick. As an academic, any standardization or at least the aim towards standardizing the framework opens up a million research opportunities. So we really look forward to playing around with the new data. However, as someone who has close ties with industry and really sees this from a practical lens, I'm really looking forward to how industry integrates this and what feedback sort of comes from the new proposal.
Great. And Julia?
Yeah, and on my side, let's embrace the chance that we continue the journey we've started in a more simpler, more effectful way, and let's not get hung up on very specific technical details in order to lose sight of what the greater idea around that is and to get it effective into place.
Yes, thank you very much, and congratulations to DG FISMA and the European Commission also for listening, for going through this process, and for making improvements for those who work on these things, either in academia or in practice. So I'm very excited to see what will come next. Thank you everyone who joined today. We will also be publishing a special analysis report, just a guidebook for the new SFDR review, which will come out on Monday. That is also part of the Sustainable Investment Forum effort to provide some additional information and to engage the market. So thank you very much, everyone, for joining us. And the recording will also be made available on Monday or maybe even tomorrow. So thank you very much. Have a good day. And please do follow also the EU Platform on Sustainable Finance LinkedIn page and the EU Economy and Finance page. They're both on LinkedIn. So every time something exciting happens or there's a new publication, you can find it by subscribing to those LinkedIn pages for timely updates. Thank you and goodbye.
Thank you.
Thank you. Bye-bye.
Thank you.